Let's go ahead and dive in here with this article in the Wall Street Journal that said boomers are hooked on stocks and they can't let go. Even though baby boomers have seen their share of significant pullbacks, they still stick with the market as more of those boomers are reaching their 70s. Do you see a reason to wean them off the stock market, or should it still be a big part of the typical retirement portfolio?
Well, when I was looking at this article before today's show, I was taking a look at what the Wall Street Journal put out there. And what it said is that nearly two-thirds of U.S. adults age 65 and older own equities through either individual stocks, mutual funds, retirement savings accounts. That's according to their April survey by Gallup. And what was also what jumped out to me is that shows, according to the Gallup poll, that that's more than any other age group. And I guess, Scott, you and I had talked about, if I was a guessing man, I would have thought that maybe the 45 to 55-year-old age group would have been the largest, biggest group of owning stock. But, when we look at it, I guess you look at the philosophy behind our firm and what we call the independent income system. And that's ultimately, it's designed to have buckets of money that are for different time frames. And so usually sooner somebody needs the money from the account, I generally would recommend less risky assets. And because stocks tend to be risky, they tend to be good for longer term investments, 5 or 10 or 15 years down the road. And, when I look at the question, should a 70-year-old be in the stock market? The answer is probably, right? It probably serves a part of their portfolio that they want to have growth associated with what their investments are. Some investors choose to live off of their dividends and interest, and maybe they own a basket of high-quality dividend-paying stocks in companies that are financially sound. So they or their firm has done some research into the financial position of the company, and if they can just live off of the dividends, then the day-to-day ups and downs of the stock market maybe doesn't have much of an impact as far as what their income needs are. At least for me personally, when I look at this stat and looking at somebody, that's 70 or older, the concern that I have is if they have a portfolio that's more growth-oriented investments. So investments that the total return of the portfolio is more reliant upon the market going up. In that type of situation where they're selling off a portion of their investments each and every month they get their paycheck, they run the risk of the sequence of return risk, meaning in a declining market, they're going to be selling off more and more shares. And so if we experience a long, extended downturn in a market, or if we experience a sharp downturn in the market that takes a long time to recover, that investor is probably one of the ones that's at the biggest risk because of the downturn in the market and that sequence of return risk.
Mm-hmm. I love the independent income system, the model, and the way you guys present that. And a lot of times when I meet with clients, they say, I'm turning 65 here, retirement. And, I always talk to them about that, and they want to know, what should I do with my financial advisor? And one of the things I say is, when you're a young investor, 35 to 60, you can afford to be a little more aggressive there, right? Mm-hmm. But when you're 65 and moving in through retirement, you just don't have the number of years left if you were to have a significant downturn in your portfolio. That's why I love the independent income system. And maybe, like you said, that number is really kind of shocking, 2/3. Maybe it's because that generation grew up on stocks.
Right.
I can remember, I'm nearing 62 myself, and it's just one of the things you did. You invested in mutual funds and stocks, and that's what we did back then.
Yeah. Jim Cramer, I was listening on the CNBC the other day, and he said, people don't talk about stocks like they used to anymore.
Right.
He would say when you're on the subway, used to be that someone would ask, "Hey, what are you buying?" or "What are your picks these days?" And younger people just, for the most part, maybe aren't interested in it, or maybe have experienced too many negative markets recently. The other thought I had too when I was reading this, Nolan, is no wonder the baby boomer generation is so addicted to stocks. I mean, from March of 2009, the S&P has returned a total return of more than 700%. And so, either it's a really good memory or just not a good memory, one of the two, where, they're just willing to weather those ups and downs. But I agree. It really depends on what area of the market you're invested in. Is it the S&P, or is it, small, medium-sized stocks. It just kind of depends, but definitely the S&P 500 has gotten a great return.
Yeah, it really, I guess maybe could even come down to as you get older, you tend to be more patient in life and, to be successful. I think one of the characteristics is trying to be successful is being patient. Not necessarily looking for the instant gratification that I think younger people tend to look for these days, where stocks tend to be a long-term investment. So, should you own stocks in your 70s? The answer is probably. It's probably part of your overall portfolio and where it fits in. Again, make sure that you do have some money set aside in case there's a big downturn in the market, and you're not in a situation where you're forced to sell off your investments at a temporary loss.
But does it need to be the entirety of your retirement plan? Probably not, for the reasons that the guys just illustrated there. If there was to be a significant market downturn, essentially, would a 6% increase as an extreme change your retirement plan in a calendar year? Would that make a big difference? No, probably not. Would a 20% drawdown make a big difference? A little bit more so, I think. So having a right blend, having that blend of money tied to the market, but also something a little bit more stable and secure for the more immediate future in your retirement. That is where something like the independent income system comes into play. And you can find out more about that by giving a call, scheduling a time to speak with the guys, 419-794-3030, or you can also go to the website as well, arhq.com.